Use a debit spread is when we have a directional bias, meaning to say that either we are very, very bullish or whether we are very, very bearish, and we expect price to have a breakout. That's the time when you use a debit spread. Now, when we expect the price to have a very mildly bullish or mildly bearish, or maybe the price just have no directions, so we can use a credit spread to receive premium as income, right? Now, there's another situation where we can use an iron condor. Iron condor is we apply when market has no direction. For iron condor is best when the market have no direction, right? So what is iron condor? Iron condor is actually four order. There are 4 order altogether. We sell a put, we sell a call, we buy a put, we buy a call. When we sell a put, we are receiving a credit, that's our income. When we sell a call, again, we are receiving a credit, that's our income. Now, if we sell a put, this is a naked put, right? A naked put is very risky, so we must buy a put as an insurance. So when we buy a put, we are paying out a premium. So when we sell a naked call, it is very risky, so we cannot do a naked call. So we must buy a naked call. When we buy a naked call, it's purely for insurance, right? So we have to pay out. So you can see that this is basically a four. Iron condor is made up of 2 spread. It's actually made up of 2 spread, right? This strategy is used on underlying stock index with expectation that price will remain in the range or no direction. So let's say example, you expect price to remain in this range, up and down. So you define where is your line on the sand. You say, well, the price is here, and I do not think that the price will go below this line. So you sell let's say this is $50, right? So you sell a $50 put, you receive $2 as your income. That becomes $200 for every contract. At the same time, you say, okay, well, I don't expect price to trade above $80. Let's say this is 80. And you sell 80 call, you receive $2 as your income. So $2 multiplied 100 share, your income received is 200. So you receive 400 altogether. Now, if you just do sell a call, you sell a put, these both legs are naked. It is very risky. So we must buy an insurance. So for the naked call, our insurance is buy a 85 call, which is $5 higher. You can buy $10 higher, $5 higher, $1 higher, $2. It's entirely up to you, right? It all depends how much risk you want to take. The difference between the spread is the width. That is our risk. So let's say we take $5 apart. So we buy an insurance $5, $85 call, and we pay $1 as a premium. So we have to pay a $1. $1 multiply 100 share, which means that $100. So our naked put, we must buy an insurance as well. So we buy a put, $45 call. Again, the difference is $5 spread, and we pay $1 as a premium. So for this iron condor, you realize that what is our profit? Our profit is the $400, the both short leg minus both long leg, $200. Our profit is $200. So our intention is, if we buy an iron condor that is last for 45 days. So what we want is, we want the price to stay within this range. We want the price to stay within this bounce around between 50 to 80. We do not want the price to trade either above 80 or below 50. We don't want that. That's the time when we lose money. So we expect the price to remain in the range. So long as within the 45 days, the price trade between 50 to $80, our iron condor contract will expire worthless, and we keep our $200 as an income. Now, what if the price trade outside the range? What if the price trade to $89, right above our short of 80? That's the time when we start to lose money. So how much we lost? Take a look, right? When the price rally up to $89, we have 4 orders here. Our sell 80 call, the premium that we collect $2. Right now it's worth $9. Why $9? Because it rally up to 89. The price right now is 89. Our sell call is 80. Difference is $9 in the money. $9. But we already received $2 beforehand when we sold the call. So now our net loss is $7. Multiply 100 share, we lost $700. Now our second order, buy a 85 call, which we pay out $1. Now the current price is $89. So our 85 call right now is in the money by $4, right? Now 89 different 85, $4. And we pay out $1 already. So our net profit right now for this leg is $300. Our sell 50 put, which we received $2 previously. So now sell 50 put, well, now the price is trading at $89. So our contract will expire worthless. We keep our $200. Our last leg, buy 45 put, which we pay out $1 as a premium. So now you can see that our 45 put right now, the price is $89. $89. Again, this contract is worthless. So we lost the $100. So if we take the difference between these four legs, we realize that our maximum loss is $300. Irregardless where the price moved to, our maximum loss is $300. Okay, so this is a situation where we lose money. Let's take a look at this example on SPY. Now the SPY currently is trading at $254. $254. Now then I say, okay, well, this is I want to sell a call, $300 call, right? For the current price to move to $300 is the SPY need to move at least 17.7%, right? Which is quite a lot. The probability for that to happen is very unlikely. And that is my line on the sand for call. My line on the sand for put is 200. So I want to sell a put of $200 put, and for current price to move down below $200 is how many percent? 21.2%. So again, the odd is very, very low. SPY can move below $200. So I define my two line, and that's where I sell a call and sell a put. But this is naked call, naked put, very dangerous. So I must buy a call and buy a put at the same time to use that as an insurance. So now I buy a call and buy a put. Sell a naked put. Sorry, when we sell a naked put, buying a put yet, you realize that our reward maximum profit is $411. Our maximum loss is $19,000. The credit that I receive is $410. The option buying power, the margin that needed, right? The effect after we buy this, right? The effect is $2,000. Now, if we sell a credit spread, you see what is the difference? For selling a naked put, right? We receive maximum profit for $411. For selling a credit spread, our maximum profit is $115. But our maximum loss is $885 compared to $19,589, right? Because we have two legs, buy and sell at the same time. Now look at the credit that we receive, right? Of course, we could be less than the selling naked put, because selling naked put, we are just selling a put. But when we do a credit spread, not only we sell a put, we also buy a put. And the buy leg, the second leg that we buy, we need to pay a premium. And that's the reason why the credit becomes less. Now look at the buying power. The margin required to put up a credit spread is much, much less compared to selling a naked put. For those traders who has a very limited small capital account, you will not able to sell naked put because the broker will not allow you to sell. But what you can do is you can actually participate using iron condor trade, because with iron condor your margin is very small. Something very similar to, you can use credit spread, right? You can use credit spread. Again, your margin is small. You don't have to care. If you don't have the kind of a big account, you can use a spread to participate in the trade. So do not say that, well, my account is small, therefore I cannot trade all options. You can, even $1,000, $2,000, you still can trade, right? You can use a spread to trade. Now let's take an example. If we just put sell a naked call, sell a naked put, our risk is unlimited. So we must buy a call and buy a put as a protection, right? So now when we do that, now we have defined risk, we have defined reward. Okay, no matter where the price goes to, the risk and reward is always remain the same. So when we put up an iron condor, right? Iron condor is actually made up of 4 orders, right? It's actually bear call spread, bull put spread. So if this contract expire on 27 April, so now is March. Until then, so long as SPY trade within $200 to $200 to $300, we are profitable. All right, we are profitable. So long as trade within the range. So for iron condor is we define where is our range, and then we just sell a call and sell a put at the same time. So let's take a look at the put here. We sell a put, $200, right? For this $200, we receive $4.11. And for the call, $300 call that we sold, we receive 76 cents. So that's all we receive. The call and the put. We must put in the insurance, which is to buy a put and buy a call at the same time. So when we buy a call, when we buy a put, the blue rectangle box, when we buy a put, 190, we are paying $3.05. When we buy a call, the blue box, you can see that we are paying 33 cents. 33 cents. And so if we get all the different here, work out all the different, you realize that we are making $149 per contract. $149 per contract. So long as the price trade within the range 200, 300, we make money. But what happened if the SPY it moved beyond the range that we define? It moved to 320. We sell $300 call. It moved to 320. Now what happened? It means that we have a loss. So how much we lost? The loss is the spread, the width minus the credit that we receive. That is the loss. So of course, the Think or Swim will calculate this for us. If the price go up to 320, which is above our 300 call and 310 call, you see what happened? Our 4 order, our buy 190 put is now worthless. So we lost the $3.05. Our sell $200 put, which the premium is $4.10. This one is also worthless. So we still keep our premium, right? So this is $4.11. Multiply 100 share is $411. Our third leg, which is a sell a 300 call at 76 cents. Right now, this is in the money by $20, right? Because we are assuming the price go up to 320, $300, the difference is $20. So now we already previously we sold a call at 300, we received 76 cents as a premium. Now the $20 in the money, right? So the difference is 19.24. That's our loss, right? Multiply 100 share is 1,924. Now our last leg, we buy a 310 call and we pay for 33 cents. But right now it is worth $10. Price rally up to 320. The difference 320, 310 is $10. $10 less 33 cents that we paid previously. So our profit is $9.67. Multiply 100 share. So you get a different, you take all the difference between these 4 legs, you realize that our maximum loss is $871. Now this is where I break all the 4 legs into individually so you can see for yourself. But when you put your order into your platform, you can see that the platform already show you iron condor, sell, buy, one contract. Right? They work out for you already. Total credit received $1.59. So you do not have to calculate all this yourself. This is just for your information. Your broker, whether it's a Think or Swim, whether it's a TradeStation, will already calculate for you. Right? So you do not have to worry. So you need to remember how much credit you receive, right? So in future, if we need to close our trade early, so let's say we receive $1.59. We receive $1.59. So in future, if the trade, the premium only left about 10% or even 20%, let's say 30 cents. If it's 30 cents, to close the trade. We will do it. We do not have to wait until the contract expires. The longer we stay in the trade, we call it diminished return. The most we make is another 20 cents. Those are the situations where we'll close our position early.